Hello everyone, this is Matthew Fraley with BreakpointTrades.com. First off, I hope everyone had a nice weekend so far. Again, despite the carnage, the absolute whirlwind the markets have been through, the crazy situations, the politics, you name it. This is the technical analysis week in review from Breakpoint Trades. It is Sunday, April 6th, and we got a lot to talk about. Again, my name is Matthew Fraley. I founded Breakpoint Trades way back 22 years ago in 2003 to provide advanced technical analysis, market commentary, trade ideas, and my passion, which is mechanical trading systems, our KISS systems in particular. They've actually done very well during this downtrend. I'll discuss that a little bit, but again, we got a lot to discuss, guys. Let's go and get started. If you're just a YouTube subscriber, definitely consider at least signing up to our free our market newsletter. You'll find it here on the homepage, and definitely consider subscribing. You get access to 5 detailed newsletters per week, actionable trade ideas. You get access to our mechanical systems. We have an active community, etc. Prices are very reasonable. We'd love to have you on board. Anyway, let's get back to the market. Like I said, guys, we have a lot to discuss here. Need to get through this, though. I have a funeral I have to go through. I was debating whether I go to the funeral first, then come back, but I wanted to get this out. So anyway, again, this market's divided into 8 major sections. These weekend newsletters, if you happen to be new to Breakpoint, they're quite comprehensive. Again, they're not for you TikTokers out there with short attention spans. You know, we get into the weeds here on the weekends. They tend to be about 40 to 50 minutes, okay? All right, so stay tuned and listen. We're going to discuss a lot of things. As far as the market, like I said, total bloodbath. For the week, unreal moves here. For the week, the Dow Jones lost 3,269 points, or 7.9%. The S&P lost 500 points, or 9.1%. NASDAQ lost 10%. Russell 2000 lost 9.6%. And again, it just wasn't for the major indexes and sectors. It was across the board. Whenever you get selling like this, everything gets sold, indiscriminately eventually. Even sectors that were holding up. And on top of that, with the tariff stuff, there's real worry about a world recession possibly. And because of that, you've seen steep losses in the commodities. Copper was down 14.2%. Crude oil down 10.6%. Silver, precious metal, which is normally up, lost 13%. Now, gold only lost 1.5%. Why is that? Again, very simple, guys. Yes, silver is a precious metal, but it is much more so an industrial commodity. Okay, gold is used in some things, but it's mainly a precious metal. Silver is more industrial, and so it's going to move if the world is worried about recession and using less commodities. Silver is the best conductor, so it's used in a lot of things. So just like copper was down 14%. Well, silver was down 13%. Okay, and as far as the tariffs here, I posted something on the trading community. I don't want to get political, guys, but you may want to look at that. I have a link here in the newsletter. I'll put it in the YouTube video. It's already on the blog. But there's a gentleman who discusses the tariffs. There's also articles out there about it. But I do think the administration could have done a better job about explaining that. It was initially put up that, hey, all these countries are charging us this percent tariff, that percent tariff, and so we're going to be nice and do a reciprocal tariff of 50%. The problem is the tariffs that they were showing were not the exact actual tariffs that the countries had. The administration was doing, an interesting equation where they were using trade deficits, okay, and not the actual tariffs. So they would take here's an example. So for Indonesia, the U.S. has a 17.9 billion trade deficit with Indonesia, while they export 28 billion to us. So if you divide 17.8, our deficit, to them by 28 billion their exports, you get 64%. And so, they said, okay, well, we'll charge half of that. We'll charge a tariff of 32%, right? The problem with that is the actual tariff that Indonesia has on us is 8.1%. So it imposed a much larger tariff than they actually have on us. The thing is, I understand the thing about trade deficit, but that's not tariff. it's not related. So anyway, again, it's starting. That's pretty well known now, but initially it wasn't. And again, we'll see how this all plays out. The best thing for the markets in the world would be everyone comes together and maybe has free trade, gets rid of tariffs, stuff like that. But again, it's a fluid, dynamic situation. All right. Again, there's a lot to discuss here. One thing, guys. Yes, the markets have had one hell of a sell-off, and everyone blames the tariffs and Trump and Doge. That said, every we were calling for a strong correction last year, back in December and January. We were calling for a pullback of 500 to 900 S&P 500 points, down to around 5,200. Okay, so that was before any of this stuff. Now, you could argue that the ferocity of this decline has been exaggerated by the tariffs and Doge, and I won't, argue that. But the point I'm trying to make is the charts were set up for a correction regardless. Even if Harris had gotten in, we still, I think, would have had a correction. Now, would it have been this strong and ferocious? Probably not. But it was still in the cards for a correction. Okay. The other thing I'll say is that I've been calling for a recession, primarily because of the yield curve. And everyone, all the pundits on TV were calling for a soft landing. Well, now everyone's changing their tune. But again, to me, it was in the charts. The yield curve was inverted the longest in history, and that's been the best gauge predictor of a recession. So why would it be different this time? Everyone, whenever they say it's different, it never is. That's one thing I've learned. Okay. Some other things, again, we'll see this pullback. We haven't, officially declared a bear market yet. Some of my longer term charts are given some warnings, like our 401k paint dry system is given a warning. I'll discuss that below. Now, this week, we did finally see a washout. All right, I was talking about that mid last week. I said, let's just get a washout and get this over with. So the VIX sold off on Thursday, or the market sold off hard on Thursday, and then especially on Friday. The VIX finally spiked up to 45. That said, is that enough? I would say probably not, but I think we're getting close. Another day or two, we could see at least a washout trade low. Okay. Now, guys, the best thing to look for would be a red to green move. Okay. That's when the market opens weak and then you get a reversal. What you don't want is a gap up in the market. That's typically not when you get bottom. So if we were to gap up on Monday or something, I would be cautious of that. Okay. But anyway, a lot to discuss. So let's go ahead and get started with things. So first chart below, item number 2. Again, I'll get into these again, but here's the VIX. So you can see the VIX closed up here at 45. Again, pretty good spike. Could it top here? It could. It's also been up into the 60s and even near 90, say in the COVID crash. So, but the point is we are getting this fear spike finally. So we could be getting close to some sort of trade low. So we'll keep an eye on that. Everyone's watching the VIX. Next, image number 3, here's the unemployment rate, which actually ticked up last week to 4.2%. But again, remember I've been showing this chart for quite a long time with the 5 and 13 exponential moving averages. It's been one of the best predictors of future recessions. It's been, sorry about that, guys. It's been one of the best things for, predicting uptrends and downtrends in the unemployment rate. You can see the unemployment rate, when it moves, it tends to trend for long periods of time, up and down. Okay. And this crossed up a year ago, these two moving averages, and I've on record saying that unemployment should work higher and we'll eventually see a recession. In fact, look at my December 8th, 2024 comments. Said it moves like a barge, blah, blah, blah. It should go up higher over time. The trend is up, recession will come. I said that on December 8th, well before all the pundits out there were calling for soft landings. Next, chart number 4, here's the yield curve. Again, this was inverted the longest in history. It's been the best predictor of future recessions, so why would it not work this time? That's why it was flabbergasting to me when pundits were discounting this last year. Why? It's always worked, so why would it not work this time? Well, people are changing their tune now. Next, image number 5, here's the weekly view of the S&P. Now this shows that wave 4 we were looking for in December and January, where we were calling for a 500 to 900 S&P pullback. So obviously this occurred, and this was in the charts well before the tariffs, well before Trump got in. So one thing you'll find with charts, guys, is a lot of times the charts predict the moves before the news. It's almost kind of psychic in a way. That said, is this still wave four? Technically, it is. It hasn't overlapped anything, but could we have something more ominous like a ultimate high? Maybe. Okay. But again, we did call. This was calling for at least a 500 to 900 point correction. We've actually exceeded that over 1,000 points now. Next, moving chart number 6. Regarding the systems, so while the mean reversion systems had a couple bad trades on that initial decline, by the way, they're still flat right now. The KISS systems have done well, especially the dailies. Here's the daily KISS high performance system. And again, it did its job, like I say here. It does very good about keeping you long-term uptrends in the market with that smart trailing stop. It's like insurance for your 401k. Okay. It got out up here. Yes, it's not going to ever catch the high, but it got out pretty good, and it kept you through, good 70% of this sell-off. So, in fact, you could buy back now, and you could beat your peers who have rode this thing down, like my brother who doesn't listen to me, even though I'm in the industry. He's got a broker with Edward Jones, and they just let him ride all this crap down. It's frustrating to me, but hey, he's the older brother. He knows best, right? But again, the KISS system did its job. Chart number 7, here's the triple Q's NASDAQ KISS system, and this really did its job. Look how long ago this got out into cash. Back in December. Exited like a boss. Maybe a little arrogant sounding, but it did. It really exited extremely well there. Way up around 518. The Q's are now 422. 100 points, guys. 20% higher the KISS system exited. So aren't you happy if you followed that in your 401k and you got out while all your friends and family and neighbors are still long the market and all scared? You're in good shape. Okay. Again, these are valuable tools, guys. Start using them. Next, image number 8. So let's go over the index sector table, what transpired last week. Again, Friday was Thursday was a bloodbath. Friday was even more of a bloodbath. I was surprised that Friday was even a stronger down move than Thursday. But look at these losses here across the board on all the sectors. Oil services down 12.3%. Energy down 9%. Look at the losses here. These are big weekly losses just on one day. Here's the weekly, of course. Big double-digit moves. Currency-wise, now U.S. dollar had a big bounce back on Friday, up 1.1%. Still down for the week, though. There is a divergence on the daily. Bitcoin's been a little stronger here lately. Now, it is weakening here in the after hours. This here is, I think, from Friday, so it's starting to weaken now. Commodities, pretty much bloody red here. Index down 5.6%. Crude oil down 9.2%. Remember, that got absolutely hammered. Recessionary fears. Same for all these metals like copper down almost 14%. Uranium, natural gas. Corn was up. One of the few commodities that were up. Precious metals finally got hit. Gold down 1.5%. Now silver, almost 13%, guys. One hell of a sell-off. Again, it's more of an industrial metal, so if there's a world recession, there's going to be less silver used or consumption. GDX, the miners, down 8.5%. Remember, I showed this as a short last week via dust that's playing out. And as far as the market, despite the big sell-off in the 10-year, 30-year Treasury yields, that means the longer-term rates are coming down. Didn't help the market, but maybe that'll help some refinancings for homes. And item number 9 shows the economic news calendar for this week. Again, it's going to be wild, guys. The main thing is going to be on the markets. I would watch that VIX and CPC put-call ratio early this week. Otherwise, you have the CPI, core PPI. That's going to be a big one here on Wednesday. That's inflationary data. So, actually, that's on Thursday, not Wednesday. I'm sorry. And let's go and jump to the charts, folks. So, first chart below, item number 10. Here's the Dow. And this is the Dow weekly chart. First off, you can see that double top that had formed essentially back in February. And then look at this sell-off. Look at last week's sell-off down 7.9%. Boom. In fact, you have the 200-week moving average, which is a long-term support generally. That's not too far away, honestly. You got a big long-term support down here around 37,000. The Dow and the markets have erased most of 2024 gains now, which is crazy. Think about that. Basically back to, May, June levels. Next, chart 11, here's the daily chart, just showing the absolute waterfall sell-off. I mean, look at these candles. Still technically a MACD divergence here, but man, unbelievable moves. Next, chart 12, here's the S&P 401k paint dry system, or the BPT 401k paint dry system, affectionately called. It's called paint dry because it holds for years at a time. It's really good for friends and family, neighbors, maybe parents who have a 401k or an IRA. They don't hardly ever want to touch it, but they want to avoid major bear markets, like 2008, tech bubble crash, stuff like that. And it's done a damn good job. Now, it hasn't officially exited yet. This is a monthly system. It makes its decision at the end of the month. But right now, it's given a sell signal. You see on my indicator here, it's red. So it is giving a warning. Now, if the market were to bounce back nicely by the end of the month, this could go away. But right now, it's given a big warning here. Okay. The average hold time on this system is like 3 or 4 years. So it's like paint dry, but it avoids the major bear markets quite well. Next, chart 13, here's a weekly view of the S&P down 9.1%. Just showing this chart, we showed this last year. We talked about how we needed to see at least a mean reversion. We talked about the sheer distance away from this 89-week moving average. That's a fib number, remember, 55, 89. And it was over 21% away. When it gets too far away, you could see last year in 2021, it was 23%. You get a mean reversion. You go back to it. Well, we got our mean reversion move, didn't we? Price is all the way back to it and below now. So that ended up playing out. Next, chart 14, here's the S&P quarterly chart. And this really illustrates how extended we are from that 2009 low. Look at this. We essentially went parabolic. Look at the slope here. On February, you had a quarterly doji candlestick there. And anyway, that was given a big warning. But look at this. The initial, we were expecting at least a mean reversion move down to the 9 EMA, and that's been more than achieved. MACD hasn't even crossed yet. I mean, ultimately this could even work down to that 20 EMA. Here's the monthly chart, chart 15, monthly view of the S&P. I showed that last week. We smashed through that uptrend line on this logarithmic chart from the 2020 lows. Next, chart 16, here's another monthly chart. This is kind of like a paint dry system too. This goes back to 94. It utilizes the 14 length stochastic. I've discussed this dozens and dozens of times ad nauseum, but again, the 14 stochastic in bull markets stays above 50%, and on corrections in bull markets finds support there. When it falls below 50%, you get bear markets, just like it would have got you out in late 2000. So it kept you out of that tech bubble crash. It's fell below here in January 2008, so kept you out of the brunt of that 2008 sell-off. And you can see during the bull market after, secular bull market, every major correction, stochastic found support around the 50% area. Okay. Now in 2022, it fell below. We had a bear market there. But notice it's come all the way down near this area. So we're near an important inflection point for the long-term uptrend. Are we going to confirm a bear market or not? By the way, guys, one thing I meant to say, bear markets are not an arbitrary 20% pullback in the market like CNBC says. That's too simplistic. Bear markets require time, and usually you get a change in leadership. The same stocks that were leading and in vogue during the bull market no longer are in the new bull market. So if you get a strong correction and CNBC calls it a bear market, but then you get a rally back up and the same leaders are leading and it's a fairly quick recovery like you had in 2020, that wasn't a bear market. It was a strong correction in a bull market. Anyway, we'll see what this does in this area, clear inflection area. Next, chart 17, another weekly view. Again, smash down through this channel we've been showing forever. and in fact undercut the 38% fib a little bit. This is from the October 2022 bear market lows. You can see the 50% area comes in around 48.19. That's potentially another target of ours around here, or this 200-week moving average. I think any of these areas would be a good area to finally dip your toe in long. Next, moving on to the dailies, chart 18. Here's that daily chart, the wedge pattern we were showing, the bearish view with that 5 weighted completed wedge. That's obviously been playing out. You can see here from the October 2023 lows, we've retraced just over 50%. You can see how a lot lines up around that 4,800 area, 61.8% lines up there. On the previous chart above, you had the 50% fib around that area as well. Next, chart 19, here's a zoomed in daily view. First off, you can see that wedge pattern in February. Obviously played out, big initial sell-off, lower high rally bounce, roughly to the 38% fib. You formed a perfect evening star pattern there. That was an excellent short. And this was an excellent short below that doji with a stop right at the highs. That would have been a good one for us to email out as an official trade. Kind of wish I had, but regardless, it's always good to point these out after the fact so you can learn for the future. But anyway, look at this. Look at the move on Friday, gapping below the lower Bollinger Bands and selling off. So we're very, very, very extended here in the short term. Next, chart 20, here's in a zoomed out view. So we lost that demand zone from September. In fact, undercut the August lows now. Next, chart 21, here's a 60-minute view. Again, just melting down here. There's no divergence here. There's a little bit on the RSI if you look. Obviously nothing on the MACD, it's like a bucket. There's a little bit of MACD divergence on a 15-minute chart, but you can see how price stalled at that supply zone back in late March. Next, chart 22, here's the NASDAQ QQQ showing that fifth wave completion out of this uptrend channel. Big dumpola, a little below the 38% fib retracement. You can see the 50% fib down there. Chart 23, here's the daily chart. You can see the wedge pattern playing out. That rally lower high stopped perfectly at the underside of the 200-day moving average before getting absolutely pummeled. Again, Thursday was a pretty good down day, but look at Friday, just absolutely dwarfs it. And chart 24, here's a 60-minute view. Again, similar look to the S&P. I mean, no divergence here really, except for a little bit on the RSI. And chart 25, here's a 30-minute view. Okay, you can see how that lower high bounce stalled at the 61.8. Again, guys, the best thing for the market would be for actually a red to green. That would mean a weak opening and then a reversal. You don't want to see a big gap up in the market. That's typically not where you form bottoms. Chart 26, here's Apple. I'm not going to show all the FANG type stocks, but everything's getting absolutely smashed. Here's Apple getting pummeled as well. Chart 27, here's IWM small caps getting absolutely punished. I mean, look at that correction off those highs. And this at the lows was basically back to 2023 levels. So erased all of 2024 gains. And chart 28, here's the 2-hour view. Just absolute smashola after stalling at that supply zone. All right, guys, that does it for the markets. Let's go ahead and move on. Here's the rates. Here's the 10-year Treasury yield. Broke down from this bear flag as expected. You can see the bearish moving average pinch. You also have sort of a head and shoulder look to it here. The hope is maybe the Fed will start lowering rates, but they got to be careful. Okay, I know Trump wants them to raise rates or lower rates, but they also don't want to incur inflation. You don't want to just lower rates to boost the stock market. You got to be careful. And that's where you get the problems of potential stagflation. That's why stagflation is so difficult, because you have a period of inflation with slow growth. It's hard to fight the slow growth with lowering interest rates without exasperating inflation. Very difficult environment to fight. Next, chart 30, here's TLT 20-year bonds. Remember I pointed out this ABC, so it's pushing up as expected. They move opposite to rates. And chart 31, high-yield corporate bonds. They were holding up better during the initial part of the correction, but they've been leaking oil too. It's going to be really interesting to see companies, how they lower their earnings estimates. That's going to be the real key, is lowering earnings. Next, let's look at some indicators here. So chart number 32, this chart actually predicted this pretty well. I showed this chart back in, December and January. This is the S&P 500 versus the Nifty 500. That's the Indian exchange. The two move together when divergences occur. You want to pay attention. The last time we had a divergence was in late 2021 when you had a lower high on the CNX 500 versus a higher high in the S&P. Then we had a big market correction. Well, we had the same thing again here, and boom, that led to our market correction. That said, we now see a positive divergence here. India market is stronger than ours. So this, I think, is starting to show early signs that we may bottom soon. Okay, so you're seeing the opposite effect now. Chart number 33, here's the VIX. Like I said, closed over 45 on Friday. We are getting the fear spike, but this could definitely spike higher, but we want to keep an eye on this now. Again, everyone's watching it. Chart number 34, here's the VIX to VXV ratio. So the VIX and the volatility ratio. So here we got a big spike, 1.23. Again, these big spikes on this ratio tend to be near major bottoms, as you can see. Now, it was a little bit higher during the COVID crash, but not a lot higher. That's why I think we're pretty close, guys. That said, chart number 35, here's the CPC put-call ratio. One thing that does concern me a little bit, though, this closed at 1.18, well over its upper Bollinger Bands, so that's usually pretty good lows, but it's not that high. You'd think that this CPC would be up in the 130s, 40s, 50s, but, maybe we see this still spike a little bit higher first. Next, chart number 36, here's the percentage of stocks in the NASDAQ above the 200-day moving average. This has now fallen to 21%. Now, it's not in oversold territory yet, deep oversold, but it's getting closer. You could see these past major bottoms tend to occur in this range. Okay, in 2022, you could see it got lower, but we're getting close. This could work down here in a day or two. Chart number 37, here's a zoomed out view back to 2007. So you could see it in 2008. All these major bottoms were down in this range. So we're getting closer. We're not quite there yet. Chart number 38, here's the S&P 500 equivalent. This is also down at 23.4%. It's as low as it was in 2023, but not at, down to these much lower levels like you've seen. But it is working its way down here. Chart number 39, here's the percentage of stocks above their 50-day moving average in the S&P. It's now down to 13%. So it's getting a bit oversold too. Chart number 40, here's an interesting one. The percentage of stocks in the S&P that are above their 20-day EMA. Now, this is at 5%. That said, look how these past major bottoms tend to occur. You tend to get this 1-2 effect. That's where the indicator gets oversold, then you get a bounce, and then it comes back like a double bottom or a divergence. So maybe, my guess, we might need to see something like that. We get a bounce initially in the market, then pull back again, then you get your 1-2, and then you get your much better sustained bottom. Okay. And chart number 41, here's a zoomed out view going back, years, and you can see again, it rarely gets much lower than these levels where it is right now. Chart number 42, here's the NASDAQ with the new 52-week highs, lows. Look at the spikes on the lows and look at the spikes on the 52-week high minus low. Below the lower Bollinger Bands, 2 consecutive days. So we are quite stretched. And chart number 43, here's the AAI minus bull bear. Again, as I've been covering, one thing concerning, this is basically in levels during typically bear market territory, like we had in 2022. In all those past years, it didn't get that deep. So it is saying we are seeing something different, than these previous markets, except for 2022. Next, let's take a look at some of the market sectors. I'm not going to cover them all. I just want to show you the carnage. Here's XLK Technology. Again, after that lower high bounce, absolute smash down. Chart number 45, semiconductors. That lower high bounce into supply resistance, dumping. Chart number 46, here's the weekly view. After breaking that coil back in early March, just absolute pummeled. It is now back to 2023 levels. Chart number 47, healthcare. It's a big sector. Look at this dump on Friday, down 5.5% on Friday alone. Chart 48, real transports down 10.8% for the week. Again, just look at these candles, guys, on these charts. Here's the daily transports. Here's chart 50 financials weekly view down 10.2%. Look at that candle. Here's the daily absolute smash. Kind of had a little head and shoulder look here, but look at that smash gap below the 200-day moving average. Essentially back to September levels. Chart 52, materials, weekly view down 8.4%. Remember, commodities getting smashed as well. Here's industrials, XLI, down 9.4%. Remember, it broke its channel about a month ago, but boom, big smash down. And one area that held up very well, but absolutely got shit canned last week was energy. Here's XLE. It was holding up extremely well. I mean, even at last Wednesday, look at that, it was up. And then look at this smash down. Thursday, Friday. Oh my God, guys. Down 9% alone on Thursday. Down huge on Friday, down huge on Thursday. This is on worldwide recession fears with crude oil dumping. Here's the weekly chart, down almost 15%. Now nearing the 200-week moving average. Chart 56, oil services also smashed, down 20.5% for the week. These are crazy moves, guys. Now, energy stocks are obviously getting quite oversold. Here's the bullish percent energy index. It's now down to 13.6%, so it's firmly in oversold territory. Chart 58, Oxy. Remember, this is Warren Buffett's favorite energy stock. One thing that bothered me during this chopping around this year was we were in this thin zone. This big candle you see up in 2022 offered no support. So, now it's sold off and it's now in at least one of the demand zones. But Warren Buffett may need to get his checkbook out and start scaling back in. So I don't know if it finds support here or down here. I'm kind of interested in these areas. That said, chart 59, these, emerging markets, everything got hit, but they are holding up better than our market. Here's the EEM SPY ratio. I said this is likely to start outperforming the S&P. We could see my comments on January 25th, and look at this. This was up 2% the week. So it was down, but it was down less than the S&P. You can see it's trying to trigger up. This is going to be due to outperform the S&P. I think it will make sense to be overweight in non-US markets. Chart 60, here's the EFA SPY ratio, same deal. It is starting to outperform now. Look at this, trying to get out of this channel. Eventually, it'd be best to be overweight this versus the S&P. Moving to commodities, chart 61, DBC, the index down 5.6%. Still in this overall channel, but absolutely smashed. Some worldwide recession fears. Chart 62, here's the daily chart. Big smash down on Friday. Kind of had a head and shoulder look as well here. You can see the left shoulder, head, right shoulder. Chart 63, here's the DBC SPY ratio. That's commodities to SPY ratio. I talked about this back in December of last year. I said this wedge looks like this ratio wants to move higher, which means commodities will outperform. And they have been outperforming, as you can see via the ratio. Chart 64, here's crude oil. Weekly view down 10.6%, smashing through this coil. Here's your next big supports longer term below. Again, getting hit on recession fears around the world. Chart 65, here's the daily. Absolutely smashed through that horizontal support. Remember, that's why energy stocks got absolutely hammered. Chart 66, natural gas, pulling back a little bit, but it's been one of the stronger commodities. Chart 67, copper, down 14.2%. You can see the doji candle the previous week, and then look at that smash down on recessionary fears. Chart 68, here's the daily. After that topping doji candlestick, look at this waterfall sell-off back to the 200-day moving average. I mean, look at that candle on Friday. That is crazy. Chart 69, DBA agriculture pulling back, still holding in here, but doesn't look bullish to me. Maybe wants to at least test its 200-day moving average. Moving on, chart 70, here's Bitcoin. So Bitcoin's down about 2% here after hours on the weekend. You could see last week rallied up, tested that downtrend line of this pattern, found resistance there. You had previously broken a bear flag. That said, it did initially bounce off this small demand zone, but this area in green, if it were to come down into here, this is a big area that I would be definitely buying. This is a bigger, stronger support. You also have the 61.8 fib retracement from the lows right here around 72,000. Chart 71, here's Ethereum. This has been absolutely smashed down about 60% off those double top highs in December. There is some active divergence forming, so I do think this is going to make a low here eventually, but you need a good trigger, guys. Don't catch a falling knife. So some of the mining stocks, well, MSTR has actually held up fairly well. I really don't like the CEO, quite honestly, but it has held up quite well. But again, be careful with these guys. You need a good reversal. Chart 73, here's WGMI. There's the miners ETF. You do have a little doji from Friday, but you need one trigger long could be taking out that doji with a stop at the low. And chart 74, HUT. Leaking oil here, but you may form a divergence. I think Eric Trump is getting into this one now or something. I don't know. And precious metals, or not before precious metals, here's the US dollar up 0.85% on Friday. It is still down for the week, about 1%. You do have a MACD divergence here, so it could try to start to bounce, maybe. Watch that. And move into precious metals. Chart 76, gold, daily. Big sell-off the last couple of days. I said to watch for a sell-off here, and we're starting to get it. We had a MACD divergence. It had a hell of a run, got to 31.60. I mean, that exceeded my $3,000 price target. So we are into a little demand zone here. I'm not confident that's going to hold. Wouldn't be surprised if we come down to the 50-day or more over time. Okay. Chart 76, here's gold on the weekly. Remember, I've been looking at this fifth wave high with this divergence. You can see we Pinocchioed above the channel before pulling in. We've had a hell of a run on gold, so some sort of decent consolidation would not be out of the cards. Chart 78, here's gold on the bigger picture monthly view. Remember, I've been favoring this is a wave 5 of 3. Not the end of the bull market, but this could be a decent high for a little while before a major wave 4 correction. You can see the RSI divergence. You can see the ribbon. So we may be due for that for the next, 6 months. Chart 70, silver. Now silver, which is, I love silver, but man, silver got absolutely nailed last week, down 13%. You can see the fifth wave high here. This, because it's such an industrial metal, it's getting hit quite hard. Chart 80, here's the daily. I mean, you could see this. It was holding up very well. And look at the sell-off Thursday and Friday of this thing. Absolutely brutal. That said, here's the bigger picture view of silver. Again, it's been stalling at the supply zone, pulled back off there. I do think longer term it'll eventually find support and rally again. But, right now it's being hit. Chart 82, GDX, the miners. Again, I said this looked toppy last week with that divergence and the intraday charts, and you can see absolutely smashed on Friday, losing that 50 EMA. By the way, the KISS system did just excellent here. It got out perfectly, and it locked in a nice gain. Chart 83, here's dust. So this was the 2x inverse ETF or GDX I put out last week. I said that area looked like it was due for a correction. This should rally. You had an absolute textbook wedge. Falling wedges like this, guys, there are 5 waves. 1, 2, 3, 4, 5. You see that? And what true wedge patterns always have a MACD divergence. Okay, so it had everything, and then little black candle on Thursday, but then a big follow through on Friday, meeting its initial target. That said, if this goes higher, break symmetry, this could form an inverse head and shoulder pattern. The last thing, guys, I'm not throwing a bunch of trade ideas in here, but because of the market correction, you may want to look at our dividend list here. Okay, I'll provide a link to it, but these are high quality dividend stocks that have paid, many of these have paid for 10 and 20 years. They pay high dividends. They're fairly stable. I have a list that paid monthly. Here's the percentages. Again, they may have changed a little bit. There's a 20% one here, and there's another one as well. But anyway, I have ones that pay monthly and quarterly. That said, it's best to buy these after a really good correction and then ride them. So it's time to start looking at some of these. I may buy a handful of these, some starter positions. Okay. So here's a couple examples. OXLC, this pays like a 20% dividend or a 22% dividend. You can see it's had a pretty good correction. So I may, some of these I may dip my toe in a little bit. Here's PFFA, pays a monthly dividend as well. Again, these are generally best to buy after a good correction like we've had. And Charbroid E7, XRMI, another one. Again, I'm not saying these are the ones to buy. I'm just giving you some examples of what they've done. But generally, these dividends plays, they're best not to chase the monthly dividend. They're best to buy them after a good correction, and we've had it. All right, guys. Thank you for all your support here. I know it's been trying times, but we'll do our best to continue to navigate you. And again, I appreciate all the support on our subscribers and of course our YouTube videos, our YouTube viewers. So anyway, guys, have a wonderful rest of your Sunday. We'll see what happens this week. Take care.